Welcome you to the Financial Markets Examiner YouTube channel, where you learn about forex, crypto, and the stock market. In this video, we'll learn about the concept of a joint stock company. So get your writing materials as we are going to learn in details. What is a joint stock company? A joint stock company is a business owned by its investors, which means investors owning a share of the company based on the amount that they've invested. It's a predecessor of the modern-day corporation and other types of registered company in the US. Joint stock companies were created to finance endeavors that were too expensive for an individual or even a government to fund. The owners of joint stock companies expected to share in its profits. Today, US companies are not organized as joint stock companies. While one could describe a business as shareholders using the term joint stock company, there is no such registration option, but instead, businesses are organized as, for example, a corporation, a partnership, or a limited liability company. There are various characteristics of a joint stock company. Shareholders of a joint stock company add unlimited liability for company debts. In the US, the legal process of registering as a corporation or limited liability company reduces liability to the face value of stock owned by the shareholder or the contribution of the LLC member. In Great Britain, the term limited has a similar meaning. The shares of a joint stock company are transferable. If the joint stock company is public, its shares are traded on registered stock exchanges. Shares of a private joint stock companies are transferable between parties, but the transfer process can be limited by agreement, for example, to family members. Historically, due to the nature of joint stock company unlimited liability, a shareholder's personal property can be seized to pay off debts in the event of a company's collapse. The different types of joint stock company. 1. Registered company. A company registers with state and local authorities to be legally allowed to conduct businesses in the organization form it selects. For example, corporation, limited liability partnership, limited liability companies, and so on. 2. Chartered company. This is a company that is incorporated under a nation's royal charter. Charter companies may have certain privileges that relate to conducting their business operations. 3. Statutory company. A statutory company is one that is established by an act of a nation's legislature to provide public services that benefit the populace. The company's responsibility and privileges are detailed by the Act. Benefits of a joint stock company. 1. A joint stock company can access large amounts of money via numerous shareholders that can be used to build a business. 2. Shareholders have a direct say in decisions relating to the management of the company. They also have the right to elect the board of directors. 3. Shares of public companies can be bought and sold freely on stock exchanges. Shares of private companies may be traded as allowed or restricted by the company. 4. Today's joint stock companies provide shareholders limited liability for debts that a company incurs. 5. New shares and debentures can be issued if the company requires additional capital. 6. Investment risk is diversified among many shareholders, not borne by one or two individuals. 7. Public joint stock companies support good corporate governance and make their internally audited financial statements available for public scrutiny. With this, we've come to the end of the video for today. Kindly share with us your feedback concerning this video in the comment section. There are several educative videos on the financial market you can watch on our channel. Note that this video is not for financial advice, but for educational purposes only. Kindly share, subscribe, and like after watching. Thanks.